Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I am Mridul Mishra and on behalf of Care Ratings welcome you to our today's webinar on NBFC to small finance banks. Appreciate your time in joining us for this webinar. To take you further, I'd like to introduce our speakers for today. We have with us Mr. Amod Khanorkar, who is a Senior Director at Care Ratings. Along with Mr. Amod, we have Mitul Budhbhatti, who is working with us as Associate Director, and Viraj Dhond as Deputy Manager. The discussion is in the form of a presentation which is visible on your screen. In case of queries, please key in the questions in the slot provided. We'll be having a Q&A session at the end of the presentation. May I request Amod to begin the session?
Thanks, Mridul. Good afternoon and welcome to Care Ratings webinar on small finance banks. I will briefly take you through the evolution of NBFCs into small finance banks. The evolution of small finance banks, SFBs, began in November 2014 with RBI releasing the final guidelines for SFBs. The primary objective of setting up of SFBs was to act as savings vehicle and supply credit to small business units, small and marginal farmers, micro and small industries, and other unorganized sector entities through high technology, low cost operations. Subsequently, in November 2015, RBI awarded 10 in principle SFB licenses, with 8 of them awarded to microfinance companies. Issuance of licenses, majorly to microfinance institutions, points to RBI's belief that it considers MFIs to be suitably positioned to cater to the needs of the unbanked population and further the agenda of financial inclusion. As these institutions were already in microfinance business, they were already complying with some of the key regulatory requirements to convert to SFB, such as 75% of the adjusted net bank credit to be allocated to priority sector lending or PSL, 50% of the loan portfolio to have a ticket size of maximum rupees 25 lakhs, and SFBs to have 25% of their branches in unbanked rural areas. As on March 31st, 2018, these SFBs, excluding Jana Small Finance Bank, as it started SFB operations from 28th of March 2018. So excluding Jana, they had a combined AUM or asset under management of about rupees 45,000 crores and deposit base of over 25,000 crores. In the today's webinar and the presentation, we would be covering briefly the portfolio mix of SFBs, followed by their borrowing profile with insights into deposit mobilization. Further, we will touch upon the financial performance of the SFBs with focus on their profitability and various factors influencing it. Within this, we will specifically discuss about operating and credit costs, its impact on profitability of SFBs. We will then go on to discuss about the asset quality of SFBs, and lastly, we will touch upon our view on the outlook for the sector as well. My colleagues Mitul and Viraj shall take you through the presentation. Over to you, Viraj.
Thank you, Amod. Good afternoon. For the purpose of the webinar, we have considered 7 out of 10 SFBs. This slide gives insight on the portfolio mix of SFBs. The loan book of SFBs mainly comprises of microfinance loan MSE loans, vehicle loans, affordable housing loans, and others. The proportion of microfinance loans has marginally reduced from 51% in FY17 to 48% in FY18. However, the proportion of microfinance loans for NBFC MFIs turned SFBs has reduced from 79% in FY17 to 72% in FY18. This is largely due to the SFB's focus on gradual diversification of loan book by entering into new product segments. Most of the SFBs expect sizable portion of their non-MFI loan book to come from new customers as well as upgrading some of the existing customers. Apart from MFI loans, SFBs have launched new products for their upgraded customers. These include small ticket home loans, loan against property, small shopkeeper loans, gold loans, two-wheeler loans, and a small overdraft facility. Moving on, this slide dwells on borrowing profile of SFBs. As seen in the chart on the left, the borrowing profile of SFBs has shown major shift on the conversion from NBFC. Proportion of borrowing from banks and financial institutions has fallen from 52% in FY17 to 34% in FY18, and proportion of borrowing from NCDs, subdebt and perpetual debt has fallen from 20% in FY17 to 10% in FY18. Since RBI does not permit banks to raise funds through bank and NCD borrowing, the proportion of these borrowing will fall significantly over time, raising the share of deposit in resource profile. As seen in the chart, the proportion of deposit has sharply increased from 17% in FY17 to 54% in FY18. The deposit profile mainly comprises of term deposit, which is 79% of total deposit, and the balance 21% being CASA deposits. As given in the previous slide, SFBs has successfully managed to mobilize healthy amount of deposit in the first year of operation. However, this deposit mobilization has higher proportion of bulk deposit, which carry higher interest rate than retail deposit. As seen in the chart on the left, top 20 depositor as a percent of total deposit stood at average of 43%, indicating higher proportion of bulk deposit. Further, as seen in the chart on the right, the average term and savings deposit rates of most of the SFB are 100 to 150 bps higher than market rates. This slide highlights the gearing level of SFBs and equity infusion done over last 3 years. At a cumulative level, the sector has received equity infusion of around 2,500 crore during last 3 years ended FY18. The same is complemented by fall in gearing levels from 4.6 times in FY16 to 4 times in FY17. Infusion at regular interval become necessary as SFB entities have concentration towards MFI, which are prone to event-specific risk. However, with the relative lower infusion in FY18 along with the rise in deposit to support business growth, SFB's gearing went up to over 6 times at the end of FY18. Overall, SFBs depict adequate capitalization and moderate gearing levels. However, SF will have to shore up capital base in line with anticipated business growth in medium term. I now hand over to Mitul, who will take over through rest of the presentation.
Thank you, Viraj. We now move on to the growth trend. While considering financial performance of SFBs, we have also taken into consideration the financial performance of these entities before conversion into SFBs to get a fair sense about portfolio growth and profitability trend. As we can see in the chart, on a combined level, the SFB loan book registered a healthy CAGR of 39% during the past 3 years ended FY18. This is despite the disruptions caused due to demonetization, implementation of GST, and farm loan waivers by some states. However, these disruptions impacted the loan book growth during FY17, resulting into subdued YOY growth of 3% in FY17 compared to 60% in FY16. During FY18, the portfolio growth again bounced back to 63% YOY increase as the sector revived post the disruptions. In line with the portfolio growth, SFB's total income also grew at a healthy CAGR of 38% during the past 3 years. Moving on to profitability, the slide displays the profitability trend of the SFBs over the past 3 years. SFB's net profit declined at a CAGR of 17% during the past 3 years ended FY18, primarily due to 80% decline in the PAT during FY18, which is reflected in the ratios. Profitability ratios have deteriorated in FY18 on account of demonetization and loan waivers, which resulted into sharp spike in credit costs for the SFBs having microfinance portfolios. SFB's credit cost as a percentage of their total average assets increased from 0.95% in FY17 to 2.14% in FY18. Spike in credit costs was also coupled with sharp increase in operating expenses during the transition phase from NBFC to SFB on account of bank branch expansion, compliance, and IT system costs. SFB's operating expenses as percentage of total average assets has increased from 5.86% in FY17 to 6.65% in FY18. Branch expansion along with conversion of existing MFI branches to bank branches has caused a rise in the OPEX. This ultimately resulted in sharp reduction in return on total average assets, which declined from 3.66% in FY17 to 0.51% in FY18. Moving on to asset quality, the slide shows asset quality trends of SFBs over the past 3 years. The asset quality, which largely remained stable in FY16 with GNPA of 1.11%, deteriorated slightly to 1.72% in FY17 due to the situation of demonetization. It further increased to 2.54% in FY18 as the impact of demonetization took time to wear off and there were rumors of loan waiver by some states such as UP and Maharashtra. The combined GNPA ratio of SFBs looks relatively stable compared to the MFI counterparts, as a large part of SFB performance is contributed by the likes of AU Small Finance Bank, which was an asset finance NBFC and exhibited relatively superior asset quality parameters even during demonetization. While major portfolio of SFBs continues to be dominated by microfinance loans, SFBs are gradually diversifying their loan books by offering newer products. Such diversification will help SFBs mitigate the asset quality risks associated with microfinance loans, which are highly susceptible to event risks. The outlook for the sector appears to be stable. the sector is well poised to grow the portfolio base as SFBs expand their geographical reach and increase penetration, along with offering newer products. However, there are challenges that the sector needs to overcome in the near to medium term. Garnering retail deposits will continue to be a challenge as SFBs have limited track record in mobilizing retail deposits and face stiff competition from existing banks and other SFBs. Further, SFBs at present have relatively lower portfolio diversification with high proportion of microfinance loans. Hence, asset quality will remain volatile as microfinance sector is susceptible to event-based risks. Profitable scale-up of new non-MFI product segments will remain critical for the prospects of SFBs and will be a key factor to monitor going forward. SFBs do not have prior experience in these new asset classes. However, most SFBs have hired experienced personnel to manage the new business segments. SFBs are expected to face stiff competition from banks and established NBFCs in these new business segments. On the profitability front, SFBs are likely to witness pressure in the short to medium term due to high operational expenses on account of high overheads, compliance and technology costs, and competitive business environment. However, some support could come from the gradual reduction in cost of funds due to repayment of high-cost grandfathered debt and build-up of the deposit base. SFBs, however, are in a better position in terms of liquidity as unlike NBFCs, they have access to the structural liquidity cushions such as SLR, CRR, and borrowing under the RBI LAF facility. This concludes our presentation on small finance banks.
Thank you, Mitul, Viraj, and Amod. Participants will be taking a break of 2 minutes before we begin our Q&A session. You are please requested to start keying in these questions in the slot provided. I repeat, we'll be having a break of 2 minutes before we begin our Q&A session. You can write your questions in the slot provided. Thank you. Hi friends, we'll be opening the question Q&A session now. I'll hand over to Mitul to take over. Thanks.
Thank you, Mradul. So we have a query from Kushal Modi, and he asks, which SFBs suffered a sharp decline in profitability? So all the SFBs which got converted from MFIs were the ones which suffered a decline in profitability. Except AU Small Finance Bank, AU was predominantly an asset finance NBFC which got converted into an SFB. The MFI turned SFBs had a dual challenge of high credit costs post demonetization and increased OPEX in light of conversion to the bank. So most of the MFI turned SFBs were the ones who suffered a sharp decline in profitability. Another query from Mr. Kushal Modi is, how was the collection efficiency affected in Maharashtra and UP where farm loan waivers had been announced? So if you look at the MFI space, parts of Maharashtra and UP were severely impacted and collection efficiencies dropped significantly. Over a period of time, we have seen for most of them, the collection efficiency is returning back to pre-demon levels. However, there are certain districts and certain regions in Maharashtra where the collection efficiencies continue to remain low. Overall, for the sector, we see that the collection efficiencies have returned back to high 90s, which were the levels pre-demonetization. We have similar questions from multiple participants about the impact of farm loan waivers on SFBs. As I understand, from by speaking to the MFIs and the SFBs, which are operating in the regions where farm loan waivers have been announced or are likely to be announced in future, the borrower is clearly aware about the fact that the waiver is for loans taken from nationalized banks and cooperative banks, and there is no waiver which is available for loans taken from an MFI or other lending institution. So the borrower on the ground seems to be aware of this distinction, and hence we are not expecting any major slippages or drop in collection efficiency because of this farm loan waivers. We have a question from Mr. Gaurav Mitul, who asks, what is your outlook on the SFB such as capital SFB, which are not MFI focused? So first of all, capital SFB is not rated by CARE. However, uh, if you look at non-MFI focused SFBs, they have their inherent strengths in terms of the kind of products that they offer. For example, AU Small Finance Bank, which we rate, has a fairly good presence in all the other asset loan products, like vehicle finance, SME finance, and other such products, giving them slightly more edge when it comes to penetrating the market vis-a-vis the MFI NBFCs. The someone like an AU, in terms of the borrower profile that they would cater to, we have seen that historically, even during demonetization, the asset quality was relatively better off as compared to the MFIs. Given that the borrower profile is, absolutely, they are borrowers at the bottom of the pyramid, which are more susceptible to event risks. So yes, non-MFI SFBs would be slightly more resilient to event-based risks as compared to MFI converted into SFBs. There's a query from Edwin who asks that considering less experience in other asset classes and the asset quality pressure in MFI, whether the asset quality is expected to deteriorate further, and how are the SFBs placed as compared to banks? So I think if we look at the MFI asset quality challenge, I think most of the MFIs uh, are well past the issues which were there at the time of demonetization. Collection efficiencies, are looking better now, and similar to what was witnessed pre-demonetization. So as far as the MFI portfolio is concerned, the credit cost should be expected to improve vis-a-vis the previous periods, and that should kind of help them help the profitability going forward. Having said that, MFI portfolio will always remain susceptible to event risks, as we have seen in the past. So immediately, if you have to compare the credit costs related to MFI portfolio, could start improving in the current year and going forward vis-a-vis the previous periods. Uh, However, yes, the MFI turned SFBs, for them the challenge is to profitably scale up the other products that they are intending to offer. There's a question from Mr. Suvir Kumar Gupta. Uh, he asks, how different has been the scenario for capital SFP as compared to other SFPs, considering that it was an existing bank? So while we don't rate capital SFB, I think the clear difference that we see there is that given that it was already a bank, the proportion of retail deposits uh, is relatively higher as compared to all the other SFBs, and so they already have a deposit base, a deposit franchise in place, which should help them going forward. What is live game? Or it's laugh? I don't know. There's a question from Saji Varghese that while SLR CRR allows better management of liquidity, it will on the other hand impact market lending and growth going forward. See, I would say that structurally, from NBFC to an SFB, having the SLR and CRR in place uh, makes the institution much more robust in terms of liquidity cushions, and hence, yeah, while uh, it would mean that that capital will not be available for lending, but at the same time, it will make the SFB structurally much more stronger than an NBFC. In terms of capital, I think the capital requirements would be driven by the growth prospects that the individual SFBs will have going forward. So I think having SLR and CRR is structurally a positive for the SFBs rather than a negative.
And I think that was the last query which was taken up for the day. Thank you all participants for taking a time out and being a part of this care ratings webinar. You can please write to us if you have any query or any suggestions, feedback in the suggestion box, which will be coming no sooner the webinar ends. Thank you and goodbye for now.